Most people love the stock market when it's green. When everything is going up, it feels exciting. It feels easy. But when it's red, that's where the stress happens. That's where people start refreshing their accounts and wondering how much they could lose. What if you could capture the upside of the market without ever seeing your balance drop when the market crashes? What if growth and protection could work together instead of against each other? Meet Sarah. She's 40, successful, and tired of market volatility. She's worked hard for what she has. She saves, she plans, and she wants a real safety net. Not because she's afraid of growth, but because she wants more stability along the way. Today, we're going to show you exactly how she uses Indexed Universal Life, or IUL, to build a tax-free retirement, and why this strategy stands out for people who want growth with protection. Think of the stock market like a roller coaster. High highs, scary lows, fast climbs, and sudden drops. And if you've ever watched your money fall during a rough market, then you know how emotional that ride can feel. An IUL is more like an escalator. It may not move with the same wild speed, but that's the point. When the market goes up, you go up. But when the market falls, the escalator just stops. You stay exactly where you are. You don't go down with the coaster. How? Through two magic words, the floor and the cap. These two ideas are what make an IUL different. In an IUL, your money isn't in the market, it's indexed to it. Most IULs have a 0% floor. If the market drops 20%, you lose 0%. That downside protection is one of the biggest reasons people pay attention to this strategy. In exchange, you have a cap, say 10%. If the market gains 15%, you keep 10%. So yes, you give up some upside, but in return, you avoid the painful losses that can take years to recover from. You trade the home runs for a guarantee that you'll never strike out. And for many long-term planners, that's a trade worth making. Here's the best part. Sarah's cash grows tax-deferred. That means the growth inside the policy isn't taxed year by year in the same way many other assets are. When she retires, she doesn't withdraw the money. She takes a policy loan. That distinction matters because it's a loan against her death benefit. The IRS can't touch it. It's tax-free income. And that can create more flexibility, more control, and more confidence in retirement. Sarah is her own bank. But wait, it's not magic. An IUL is still insurance, and it only works well when it's structured properly from the beginning. As Sarah gets older, the cost of insurance inside the policy goes up. If the market stays flat for 10 years and she doesn't fund the policy correctly, her bucket could run dry. That's why proper design matters so much. This is why proper structure is everything. Not just having the policy, having the right policy, funded the right way, with the right long-term plan behind it. For Sarah, the IUL was the perfect middle ground. Growth, protection, and tax-free access. That's what made it work for her. It gave her a strategy that felt more stable, more intentional, and more aligned with the future she wants. Is it right for you? It depends on your timeline. It depends on your goals. And it depends on how much value you place on protection along the way. If you want the escalator instead of the roller coaster, click the link below to learn more.
If you like this content, go ahead and subscribe. And please like and share this video.